The idea and the propaganda that was put out by the Fed and the White House and the Congress that non-monetary factors caused the inflation problem, all this rubbish, and it's pure rubbish. What caused it is the explosion in the money supply.
The Fed ends up driving the budget deficits even higher, and that ultimately is the source of inflation because it's the Federal Reserve that ends up monetizing all that government debt. That is, what's driving the problem.
You're absolutely wrong on this, and let me tell you why.
Federal Reserve officials engaged in a deep punning debate over whether U.S. interest rates are sufficiently high, especially heightened by a recent survey indicating a surge in consumers' inflation expectations. The Bureau of Labor Statistics is set to unveil its latest U.S. Consumer Price Index report, anticipated to reveal a year-over-year headline inflation of 3.4% in April, slightly lower than March's 3.5%, as per Reuters poll. Steve Heaney, a professor of applied economics at Johns Hopkins University, and Peter Schiff, chief market strategist at Euro-Pacific Asset Management, sparred over their viewpoints on inflation, economic growth, and interest rates. Schiff accentuated the role of credit expansion in driving inflation, while Heaney drew attention to the contraction of the money supply and its historical implications for economic activity and inflation. Despite stubborn inflation and interest rates hitting a two-decade high, Americans persist in their post-pandemic online spending spree in 2024. One significant factor behind this surge is consumers' increasing tendency to postpone payments, reflecting a 6.8% decrease in consumer spending in April compared to March. The M2 money supply peaked at $21.72 billion in April 2022, but by March 2024, it had dwindled to $2.84 billion, marking the first decline of at least 2% since the Great Depression, totaling a 4.06% decrease over approximately 2 years. Schiff highlighted in a recent tweet the potential escalation of federal budget deficits if the Fed maintains interest rates at current levels. Rising deficit spending amplifies pressure on consumer prices, especially when weaker dollar and higher rates contribute to increased inflation. Conversely, Heaney foresaw a sustained decline in inflation, possibly falling below the target level by early 2025. This exchange underscores the complexity of economic dynamics, with Schiff and Heaney offering contrasting perspectives on the interplay between monetary policy, inflation, and economic growth.
Yeah, well, first of all, too, remember, inflation is not just an expansion of the money supply, but also the supply of credit, because consumers could buy using credit just as if they had actual cash. And that's what's been going on. Even though the Fed has raised interest rates, people keep on borrowing and spending. Household debt at record highs, credit card debt at record highs, government debt, deficits running at a record pace. So the Fed has really had no effect on slowing down credit growth, and all of this is fueling inflation. But the box that the Fed is now in is if raising interest rates is their tool for fighting inflation, apart from the fact that interest rates are also a cost that businesses have to pass on to their customers, just like rents or raw materials or labor or any other cost. The problem for the government is as interest rates go up, budget deficits automatically go up because it costs the U.S. government a lot more money to refinance all the maturing debt, plus to finance all the new debt. And to the extent that that increase in interest rates dampens the economy, it also leads to a reduction in tax revenue, an increase in other government spending. And so the Fed ends up driving the budget deficits even higher. And that ultimately is the source of inflation because it's the Federal Reserve that ends up monetizing all that government debt. That is, what's driving the problem. And I think ultimately, as our budget deficits are exploding, it's going to cause a big loss of confidence in the dollar and U.S. Treasuries. And so as the dollar starts to fall, that puts even more upward pressure on consumer prices because the dollar now has less value internationally. And so, everything that you buy is going to be more expensive.
The money supply dominates. And since the money supply has been contracting for quite some time, actually since March of 2022, It's contracted by a little over 4%, which is not totally unprecedented, but almost completely unprecedented. We've only had 4 contractions ever in the money supply since the Fed was established in 1913. And we have to go way back to the 1940s to even find the first contraction. 48, 49, it contracted. Then we go back into the 30s, 37, 38, it contracted. And then, of course, a huge contraction in 29, 33. That was a Great Depression. And we had another contraction in 2022. So they're rare, and we haven't seen them for a long time. And every time they've occurred in the past, we not only have had a recession, actually one depression out of the 4 that I mentioned. The other 3, we had pretty good recessions. So that's an economic slowdown, which we'd expect from the slowing of the money supply and contraction of the money supply. But also remember that there's a sequence of things that happen after there's a significant change in the money supply. The first thing, asset prices change. And then with another longer lag, the economic activity changes course. And then with the longest lag, inflation. And inflation, John Greenwood and I anticipate that it's going to continue to go down, even though we've had a little stickiness here the last 3 months, and we'll go down to the target level, or if not below, by probably not the target now by the end of the year. With these last 3 months of sticky inflation, it's probably going to push that 2% level off until sometime early in 2025. But that's all really baked in the cake. It doesn't matter what the Fed's doing now. It's already happened because monetary policy has an effect on things with very long and very, very highly variable lags. So that's more or less my picture. It's a little bit different than what Peter was talking about, inflation going up.
The Federal Reserve has raised its key rate to a 23-year high of 5.3% in an attempt to curb inflation, which reached its peak at 9.1% in June 2022. However, despite these significant rate hikes, Americans, on average, spent only 99.8% of their after-tax income on interest and principal payments on their debts in the fourth quarter of last year. 2 years earlier, before the Fed increased rates, this figure was even lower at 99.5%, marking a historically low percentage. Expressing doubt about the ability to expand the economy enough to absorb substantial deficits, Peter Schiff argues that debt is growing exponentially. He advocates for higher interest rates as a solution. Meanwhile, Steve Hanke outlines 5 foundational elements for achieving prosperity, covering taxes, government expenditure, monetary policy, regulation, and international trade.
That we can actually afford these massive deficits. I mean, maybe, but is it likely? Is it even a realistic possibility? I don't think so. And the debt at this point is just growing exponentially. That is the problem. And much higher interest rates are necessary than the rates we have right now. I believe we're in a recession. I just don't believe a lot of the numbers that we get from the government. I know that the Great Recession of 2008, it began in December of 07, but they didn't officially acknowledge it until December of 08, and they went back and they revised an entire year's worth of data to show that we had been in a recession for the entire year. And even up until mid-2008, most economists and Wall Street strategists didn't see a recession coming, even though we were in the middle of the Great Recession. So I think something similar could be going on. And I also think that the weakness in the economy, this stealth recession, is the reason that Biden and Harris are so unpopular. And if you look at these polls, where they score lowest is on the economy. And so how could they be blamed for a lousy economy if the economy is great, which is what the politicians are telling us, and Wall Street and the bankers. But the public is telling us that it's not good, because if it was good, they would be crediting Biden. But they're not. They're blaming him because it's lousy. So I think we have a recession. I think we have inflation, which means we're already in stagflation. I just think we have a lot of stag and a lot of inflation, despite the fact that Powell claims to see no evidence of either.
The growth in the U.S. economy, the potential might go up to 6% per year. This is just total nonsense. This is not going to happen. The potential growth rate long run in the United States is about 2.2%, something like that. And if you look at the policies that we have, there are 5 pillars for prosperity. You've got to look at taxes. What's going to happen with taxes? Well, I think, unlike Peter, I think taxes are going up probably. So that's bad. That's going to hold back prosperity. Government restraints, that's restraint on government spending. That's probably not going to happen unless we get a constitutional amendment. So that's a negative. Monetary policy. Well, I think we have a problem because we have this big deficit that Peter and I are both worried about, and the CBO says is unsustainable. And one way to eliminate that unsustainable deficit is an inflation tax. So that means a monetary policy is going to be vulnerable to monetizing some of this. The fourth thing is regulation, and regulation's getting worse. More red tape. That holds back the potential. And the last thing is international trade. And we've got more and more protectionism, more and more sanctions, and that's going to hold back competition, productivity, and potential growth. So if you look at the 5 pillars, taxes are probably going to get worse. Government spending is probably going to get worse. Monetary policy is probably not going to be fully corrected and not be helpful. Regulatory policies, more and more red tape, that's bad. And international trade, more protectionism. So if you look over the landscape of the 5 pillars, they're all pretty shaky.
The Federal Reserve is particularly concerned about the risks posed by credit crunch, commercial real estate, and persistent inflation. Despite these concerns, Americans currently carry less debt as a percentage of their incomes compared to 15 years ago during the housing bubble. However, the Fed cautions that a credit contraction could potentially lead to a slowdown in economic activity. What are your thoughts on this matter? Your input is valued, so please feel free to share your thoughts in the comments. If you found this information helpful, don't forget to give it a thumbs up and subscribe to stay informed. Thank you for being a part of this journey with us.